Trump is about to hit the markets with a move so big it could look like someone pulled the plug on the current system and plugged in a new one, and there is a very specific date on the calendar where the shock hits first. If you think this is just politics news, you're the one holding the bag in this story. Welcome back to the comment section with Thomas Paul. Today we're talking about Trump's plan to flood the market, what that actually means beyond the headlines, and how real people with 401s, Ks, index funds, or a few stocks on Robinhood end up paying for it. Here's the setup. Trump has been openly floating huge across-the-board tariffs again, double-digit numbers on imports, especially from China and other major trading partners. Not some targeted tweak, but a broad tax on foreign goods coming into the U.S. Here's where things get interesting. A lot of people hear tariff and think, cool, punish China, bring jobs home. That's the slogan. But in market language, tariffs are a hidden sales tax on everything built with imported stuff. Cars, phones, appliances, construction materials, even your grocery bill when fuel and fertilizer get more expensive. So when he talks about jacking up tariffs on a specific date, day one in office, or a fixed start date right after inauguration, you're basically putting a countdown clock on a nationwide price hike. And markets hate countdown clocks. During his first term, every time there was a tariff escalation, you saw the same pattern. Stocks wobble, global trade slows, companies delay investment. CEOs don't plan factories when the rulebook might change next quarter. They sit on their hands and their cash. But it's even getting worse this time. The numbers floated are bigger, and the starting line is clearer. So what does flood the market really mean here? Think of three waves hitting almost at the same time. Wave 1. Importers rush to front-run the tariff date. If you know a 20, 30, or even 60% tariff is about to hit, what do? You cram as much product as possible into the country before the deadline. That means a literal flood of goods. Containers, cars, electronics, everything that can be shipped early. That short-term flood sounds good. Yay, more stuff. But it crushes pricing in the near term. Retailers discount to clear inventory. Margins get squeezed. Smaller businesses who can't manage that timing get wrecked. And here's where things take a step further. Wave 2. After the date, the tap suddenly tightens. Those same goods now cost way more to bring in. So you go from temporary oversupply to a slower, more expensive flow of imports. Companies raise prices to protect profit. Consumers cut back spending. That's inflation plus recession pressure at the same time. Economists have a fun word for that: stagflation. Wave 3. The currency and bond markets start playing defense. Foreign investors hear, wait, the world's biggest economy just slapped taxes on global trade again? Uncertainty goes up. When global trade is harder, global growth slows. Money either rushes into safety assets like gold and treasuries, or it decides U.S. assets are less attractive and goes elsewhere. But then the unbelievable thing happened. We've already seen what happens when rule makers flip the table overnight. Think of the new banking rules and Basel changes that suddenly made gold Tier 1 real money. Quiet regulation shift, huge ripple effect. Gold and silver went wild, paper contracts got stressed, and people who were asleep at the wheel paid the price. Tariffs on a fixed date are the same logic, but for everything in your house. So what are the key takeaways here if you're not running a hedge fund from your basement? First, this isn't just about, will the stock market go up or down if Trump wins? That's the lazy version. The sharper question is, which sectors get squeezed and which ones quietly benefit from chaos? Manufacturing that relies heavily on imported parts? Pain. Retailers with thin margins? Pain. Companies who can pass costs to consumers because they're monopolies or near monopolies? They'll complain on TV, then raise prices anyway. Here's where things get interesting. Second, tariffs are a political weapon, but markets see them as a math problem. If the cost base of companies goes up, profit margins fall, unless they slash jobs, cut investment, or raise prices. They usually try all three. Regular workers and consumers eat that loss. When I was 12, my parents lost a big chunk of their savings because they trusted a bank advisor who made everything sound safe. No drama, just a few strategic decisions that turned out badly. Dinner got quiet for a long time. That's what I think about when I hear politicians talk about tariffs like they're free leverage. They're not. Someone pays. Third, there's a legal angle. The more a president uses tariffs as a blunt object for everything, immigration, foreign policy, negotiations, whatever, the higher the chance it ends up in the Supreme Court. If courts suddenly pull back executive tariff powers, you get another shock. Markets priced in one set of rules, and then the referee changes them mid-game. But it's even getting worse. So what do you actually watch in real time? Number 1, the calendar. If there's a clearly stated tariff start date tied to an election outcome or inauguration day, that's your countdown clock. Markets will start repositioning before that date, not after. Number 2, insider behavior. When big new rules or shocks are coming, smart money moves early and quietly. You've seen billionaires unloading tens of billions in stocks while the public is still told everything is fine. If you see insiders dumping import-heavy sectors or consumer discretionary names while talking patriotism on TV, that's a tell. Number 3, volatility. Option pricing, credit spreads, and currency swings will spike if the market thinks this isn't just campaign noise, but a real policy path. And here's where things take a step further. In terms of how I plan to invest, no, that's not your cue to YOLO into some random tariff play stock. When everyone chases the same obvious story, it usually ends badly. When I was in my 30s, I ignored the trendy stuff and bought boring, unloved assets. It didn't make for great party stories, but it actually worked. So in terms of my own plan for investing in a world where tariffs might flood and then choke the market, here's what I think. Focus on balance sheets, not headlines. Companies with strong pricing power, low debt, and diversified supply chains are in a different league than the ones living month to month on cheap imports. And in terms of my own investments and how I plan to invest, here's what I'm doing. I'm not betting on one person, one election, or one date. I'm spreading risk across assets that don't all depend on global trade staying smooth. Some exposure to real assets, some to quality stocks, and a lot less faith in "this time it's different" speeches. Quick pause here, because if you're listening to this thinking, I'd love to talk about this stuff on YouTube, but I don't want to be on camera, the way this channel runs might actually help you. This video was created with Fludge.io, the same system that powers this entire channel. It researches topics, builds out scripts, creates the thumbnail, uses an AI avatar, and uploads to YouTube. You stay in control. You can jump in at any step, write your own script, record your own video, or just review and hit publish. Over time, it learns what works for your niche, finance, news, whatever, and gets better. So if you've been wanting to start a faceless channel without turning your life into an editing dungeon, check out Fludge.io. But then he said this unbelievable thing back to Trump and the flood. The real danger isn't just one tariff schedule. It's the normalization of sudden, giant policy swings as a negotiating style. I used to work at a local newspaper in college and watched how they'd spin the same economic story into totally different headlines. That's when I learned policy is one thing, but the narrative is what moves regular people. So when leaders brag about using tariffs like a sledgehammer, the narrative turns into strong leadership. Meanwhile, investors who don't read the fine print get whiplash when those same tariffs squeeze earnings and jobs. Here's where things get interesting. If you remember nothing else from this, markets don't crash the day you see the scary headline. They move when rules quietly change on a specific date in a PDF nobody reads. By the time it's on cable news, the big money already moved. Disclaimer time. Nothing in this video is financial advice. It's for education and entertainment only. I don't know your situation, your risk tolerance, or your time horizon. Talk to a licensed professional before making investment decisions, and don't base your future on a YouTube video. Yes, even this one. I want to hear from you on this one. Do you think Trump's tariff threats are smart leverage or a grenade rolled into the global economy? And how are you positioning your own money if this flood the market plan actually happens? Drop your thoughts in the comments. I read as many as I can. If you found this breakdown useful, hit like, subscribe to the comment section with Thomas Paul, and turn on notifications so you don't miss the next time someone in power decides to fix the economy with a 3-word slogan and a massive price tag. Thanks for watching, and I'll see you in the next one.